It broke $90. And that single number carries more weight than most people realize, because round numbers are not just psychological milestones. They are pressure points where narratives change, risk models break, and forced decisions happen. For months, even years, analysts argued that prices above 80 or 90% were unrealistic, unsustainable, or purely speculative. Those arguments were built on assumptions that supply would respond, that demand would cool, or that the market would self-correct. But squeezes do not respect assumptions. A squeeze is what happens when theory collides with reality, and reality wins. At its core, a squeeze is about imbalance. Too many claims chasing too little supply. Too many promises built on the idea that prices would stay contained. When that containment fails, the move is not gradual, it is violent. To understand why this move went parabolic, you have to understand how leverage works in modern markets. Most trading today is not done with fully paid assets. It is done with margin, derivatives, futures, and structured products that amplify both gains and losses. When prices move slowly, leverage looks harmless. When prices accelerate, leverage becomes a trap. Imagine a crowded elevator where everyone is calm as long as it moves smoothly. The moment it jolts, panic sets in and people rush for the exit. In markets, that exit is buying back positions that were sold short or hedged cheaply. Once price crosses key levels like $90, margin requirements increase, risk limits are breached, and automated systems are forced to act. That forced action is fuel. It creates buying that has nothing to do with belief and everything to do with survival. This is why the word squeeze matters more than hype. A squeeze is mechanical. It is not about optimism or fear in the abstract. It is about math. If there are more obligations to deliver than there is available supply at current prices, the price must rise until supply appears or demand is destroyed. In many commodity and precious metals markets, supply cannot appear quickly. Mines cannot double output overnight. Inventories are finite. When demand spikes, whether from industrial users, investors, or entities needing physical delivery, the only variable that can adjust fast enough is price. Breaking $90 signals that the adjustment phase has begun. Historical context makes this clearer. Look back at previous parabolic moves in commodities and metals. In 1980, silver's run was dismissed as a bubble until it wasn't, and then it was too late for most participants. In the 2000s, oil breaking above psychological thresholds triggered cascading effects across currencies, equities, and geopolitics. More recently, short squeezes in equities showed how quickly prices can disconnect from fundamentals when positioning is lopsided. The common thread is always the same. The market spends a long time coiling, frustrating both bulls and bears, then releases that tension in a compressed time window. What feels shocking in the moment is often years in the making. The move through $90 also tells us something important about confidence. Markets do not break key levels unless a critical mass of participants either cannot or will not defend them anymore. That defense might come from producers hedging, from banks managing exposure, or from traders betting that rallies will fail. When price slices through those defenses, it means sellers are stepping aside or being overwhelmed. This is where the language shifts from rally to squeeze, and from squeeze to parabolic. Parabolic does not mean the move will go straight up forever. It means the rate of change has increased dramatically. The curve steepens, pullbacks become shallow, volatility expands, time compresses. For viewers wondering whether it is already too late, this is where perspective matters. Most parabolic moves feel extended at every stage. At $20, people said it was too late. At $50, the same. At $70, caution dominated. Yet the market kept climbing because the underlying imbalance was unresolved. Getting in does not mean chasing blindly. It means understanding where we are in the cycle. Early stages are driven by fundamentals. Middle stages are driven by positioning. Late stages are driven by emotion and headlines. Breaking $90 suggests we have moved decisively out of the early stage. But that does not automatically mean the end is near. Many historic moves doubled or tripled again after breaking their most watched levels. Another reason this squeeze matters is what it reveals about trust in paper markets versus physical reality. In precious metals especially, there is a long-standing gap between paper claims and physical supply. Futures contracts, options, and unallocated accounts all assume that most participants will settle in cash, not demand delivery. That assumption holds until it doesn't. When enough players want the real thing at the same time, stress fractures appear, premiums rise, delivery times stretch, arbitrage breaks down. These are not theoretical risks. They have appeared repeatedly in past periods of stress. A parabolic squeeze often coincides with those stresses becoming visible to a wider audience. Think of it like a dam hole. Ding back water. Small leaks appear first, ignored or patched. Pressure builds silently. When the dam finally cracks, the release is sudden and unstoppable. The price breaking $90 is not the flood itself, but it is the crack everyone can now see. It forces a reevaluation of what is possible. Targets that once sounded absurd start to sound conservative. Analysts who were bearish at 60 become neutral at 90% and bullish at 120. This is not because they suddenly changed their beliefs, but because price forces belief to change. The phrase "get in" is controversial because it sounds reckless, but in the context of a squeeze it really means get informed. Understand your risk. Understand position sizing. Understand that volatility cuts both ways. Parabolic markets reward patience on the way up, but punish complacency near turning points. Yet they also punish those who stay on the sidelines waiting for perfect clarity that never comes. The market does not ring a bell to announce the best entry. It only offers probabilities. Right now, the probability that this move is driven by structural pressure, rather than pure speculation, is higher than it was at lower prices. That is uncomfortable, but it is also how major trends unfold. As this squeeze continues, every dip will be interpreted differently than before. Instead of signaling weakness, dips become opportunities for those who missed earlier levels. That shift in behavior is another hallmark of parabolic phases. Media coverage intensifies, social interest spikes, skeptics become quieter, supporters become louder. None of that changes the mechanics underneath. Supply constraints, leveraged positioning, and forced buying remain the drivers until something breaks the other way. The key is recognizing that $90 was not the destination. It was the checkpoint where the journey entered a faster, more dangerous, and potentially more rewarding stretch because once a market crosses into this phase, the forces driving it become less about opinion and more about obligation. And that distinction is critical if you want to understand why the squeeze did not slow down at 90 but instead accelerated. Obligation is what separates a normal rally from a parabolic one. In a normal rally, buyers choose to buy. In a squeeze, sellers are forced to buy. That single difference changes everything about how price behaves, how fast it moves, and how far it can ultimately go. When short positions are built on the assumption that a price level will hold, that level becomes a trap. The moment it breaks, every tick higher increases losses, tightens margin, and reduces optionality. What starts as discomfort turns into urgency, and urgency turns into panic buying. This is where many people misunderstand risk. They assume the greatest risk is at higher prices, but in a squeeze, the greatest risk often belongs to those who are positioned against the move. If you are short or synthetically short, through derivatives, your losses are theoretically unlimited. If you are long with defined risk, your downside is known. That asymmetry is why squeezes can run far beyond what fundamentals alone would justify in a calm market. The market is no longer pricing value, it is pricing escape. Every participant caught on the wrong side is asking the same question, not where is fair value, but how do I get out without destroying my book? The structure of modern markets amplifies this effect. Algorithmic trading systems react to volatility, momentum, and liquidity conditions in milliseconds. When price breaks a major level like 90%, those systems flip from providing liquidity to demanding it. They stop selling into strength and start buying to reduce exposure. At the same time, options markets begin to feed the fire. Call options that were far out of the money suddenly move closer to being in the money, forcing market makers to hedge by buying the underlying asset. This is known as gamma hedging, and it can turn a steady rise into a vertical move. Each dollar higher requires more buying, which pushes price higher still. It is a feedback loop that feeds on itself until something interrupts it. Interruptions usually come from one of three places. Supply suddenly appears, demand collapses, or an external shock changes behavior. In the current environment, supply is the least likely candidate. Physical supply chains do not respond quickly to price. Mines, refineries, and logistics operate on long timelines. Even above-ground inventories, if they exist, are often already spoken for or held by owners unwilling to sell into a rising market. Demand collapsing is also unlikely in the short term, because much of the demand in a squeeze is forced. It does not care about price sensitivity. That leaves external shocks such as regulatory changes, emergency interventions, or sudden shifts in macro conditions. Until one of those appears, the path of least resistance remains higher. This is why parabolic moves feel surreal while they are happening. Every instinct trained by years of mean reversion says this should not continue. Every commentator warns that it has gone too far. And yet, price keeps grinding higher, punctuated by sharp pullbacks that shake out weak hands before the next leg up. Those pullbacks are important. They are how the market redistributes positions from impatient participants to stronger ones. They create the illusion that the move is over, only to resume once selling pressure is exhausted. Understanding this rhythm is essential if you want to survive, not just participate. Another critical element often overlooked is the role of trust. Markets are built on trust in clearing mechanisms, counterparties, and settlement systems. During squeezes, that trust is tested. When prices move too fast, questions arise about whether contracts can be honored, whether delivery can be made, and whether intermediaries can manage the risk. These questions do in OT have to be answered negatively to impact behavior. The mere possibility causes participants to reduce exposure, demand more collateral, or move toward assets they can control directly. This behavior further tightens available supply and adds to upward pressure. It is not conspiracy, it is rational risk management under stress. The phrase "get in" starts to make more sense here, not as a call to reckless speculation, but as a recognition that waiting for perfect confirmation often means missing the structural part of the move. By the time mainstream consensus agrees that the squeeze is real, much of the repricing has already occurred. That does not mean there will not be opportunities later, but the risk-reward changes. Early participants are rewarded for foresight. Later participants must manage volatility more carefully. The market does not care which category you fall into. It only cares about balance between supply and demand. We also need to talk about narrative shifts because narratives matter more than people admit. Before 90% broke, the dominant narrative was containment. Analysts spoke about ceilings, resistance, and fair value. After 90%, the narrative shifts to discovery. Price discovery is what happens when the market admits it does not know where equilibrium is. In discovery mode, old models break. Historical correlations weaken, forecasts widen. This is uncomfortable for institutions that rely on stability, but it is fertile ground for outsized moves. Very new high becomes a data point that forces recalibration. Targets that once seemed aggressive become stepping stones. Look at how quickly language changes. A move is first called a bounce, then a rally, then a squeeze, then a mania. Each label reflects not just price action, but collective psychology. Right now, we are in the squeeze to early parabolic transition. That is the phase where disbelief is still widespread, but cracks are forming. Commentators hedge their words, risk managers increase buffers, media coverage becomes more frequent but still cautious. This is often the longest and most powerful segment of the move, because it is driven by structural forces rather than retail frenzy. Of course, no parabolic move lasts forever. Gravity always returns. The challenge is that gravity does not announce its arrival. Tops are processes, not moments. They form when forced buying exhausts itself and marginal demand weakens. Signs include failed breakouts, increasing volatility without progress, and shifts in volume patterns. None of those are present simply because a price is high. They appear when the underlying imbalance resolves. Until then, calling a top is less analysis and more guesswork. Many fortunes have been lost trying to short parabolic moves too early. For those watching from the sidelines, the temptation is to either jump in emotionally or dismiss the entire move as madness. Both reactions are understandable, and both can be costly. A more productive approach is to ask better questions. What is driving the move mechanically? Who is being forced to act? What would need to change for the squeeze to end? These questions keep you grounded when price action feels irrational. They also help you separate noise from signal. As price continues to explore territory above 90, every additional dollar carries information. It tells us about the resilience of demand, the desperation of shorts, and the willingness of holders to part with supply. So far, that information has been one-sided. Sellers are scarce. Buyers are persistent. That does not guarantee what happens next, but it does tell us that the squeeze is not yet resolved. And as long as it is unresolved, the risk of further acceleration remains because